The valuation hangover. Wall Street faces its AI reckoning amid Washington's shutdown drama. In a week where markets once again danced between euphoria and anxiety, Wall Street is waking up with a valuation hangover. The artificial intelligence boom that sent tech stocks soaring all year has finally run into a wall. And this time, it's not just about missed earnings or cautious guidance. It's about belief. The belief that the AI revolution could justify sky-high valuations is starting to crack. I'm your host, and today we're diving into how valuation worries, political gridlock, and consumer stress have combined into one of the market's most uncertain stretches of 2025. Segment 1. The market's mood turns south. After months of breathtaking gains, the Nasdaq tumbled 3% this week, its worst performance since the Liberation Day tariff shock back in April. Nvidia and Palantir led the rout, dragging the tech-heavy index down as investors questioned whether the AI gold rush has gone too far. The S&P 500 slid 1.7%, and the Dow lost 1.3%. For context, that's the first 3-day stretch of red in nearly a month. But this isn't just a technical pullback. It's a sentiment shift. Nvidia lost over 7%, its steepest weekly drop in more than a year. Palantir tumbled after earnings showed strong demand, but even stronger expectations. Meanwhile, Microsoft and Meta shed more than 4%. Together, AI-linked giants wiped out over $820 billion in market value in a single week. Segment 2. The ghost of valuation passed. The story goes deeper than just numbers. As Thomas Shipp from LPL Financial put it, markets are caught in a tug of war between the incredible potential of AI and the uncomfortable math of its price tags. When Sam Altman of OpenAI talks about $1.4 trillion in commitments over the next 8 years, investors hear both ambition and alarm. Obviously, Altman said, this requires continued revenue growth. That's the heart of the matter. The market has already priced in perfection, rapid adoption, fat margins, and near monopolistic scale. But profits, they're still theoretical. Many of these AI players are burning through billions just to build the infrastructure they hope will one day pay off. NVIDIA's circular web of investments illustrates the concern. The chipmaker sold $6.3 billion worth of capacity to CoreWeave, a company it also partly owns. It's like selling yourself a dream and booking the profit now. Optimists call it strategic synergy. Skeptics call it bubble logic. Meanwhile, in Washington, the government shutdown, now the longest in U.S. history, has entered its 6th week. Federal data releases, including inflation and jobs reports, have been delayed. That means investors are flying blind. Consumer sentiment hit a 3-year low, and October saw the highest job cuts for that month since 2003. It's not just bureaucrats missing paychecks. It's the entire feedback loop of the economy. Without updated data, traders can't read inflation trends, the Fed can't fine-tune policy, and the public loses faith in leadership. Ironically, just as America debates how much to spend on AI supremacy, its own government has stopped functioning long enough to threaten economic stability. Segment 4. The AI race narrative shifts. Adding to market unease, NVIDIA CEO Jensen Huang warned that China will win the AI race if the U.S. continues to restrict chip exports. Within hours, he walked it back on social media, saying China is merely nanoseconds behind America. Still, the remark landed like a thunderclap. It reminded everyone that AI isn't just an investment story, it's a geopolitical one. And for companies dependent on global supply chains, every trade barrier adds another layer of risk. Investors are realizing that the AI race isn't only about compute power. It's also about political will, global cooperation, and regulation. 3 things currently in short supply. Segment 5. When fast casual isn't fast enough. Outside of tech, another story unfolded quietly but meaningfully. The decline of America's fast casual dining sector. Papa John's lost over 20% of its market value after private equity firm Apollo Global backed out of a $2.2 billion buyout. Pizza Hut, struggling with its 8th straight quarter of falling sales, may go private just to survive. Chipotle cut its full-year sales outlook for the 3rd quarter in a row, blaming economic headwinds and a broad pullback in spending among young adults. The 25 to 35-year-old demographic, once the backbone of urban dining, is being squeezed by student loan repayments, slower wage growth, and rising unemployment.
analysts at TD Cowen now warn that the fast casual space has over-indexed on younger consumers, who are cutting back. It's a cautionary echo of a larger problem. When growth sectors over-concentrate on optimism rather than resilience, the crash feels inevitable. Segment 7. The few bright spots. Not every company is hurting. McDonald's continues to thrive, reporting same-store sales beating expectations for the second straight quarter. The fast food giant is capturing a new wave of higher-income consumers, trading down from pricier restaurants. That's the paradox of this economy: resilience at the top, retrenchment at the middle, and pain at the bottom. The same imbalance playing out in the stock market is mirrored in real-world consumption, a concentration of strength surrounded by fragility. Segment 8, the road ahead. Looking forward, the week ahead is quieter on paper, but loaded with uncertainty. CoreWeave, Ookla, and Rocket Lab headline the final wave of Q3 tech earnings. The Walt Disney Company, Paramount Skydance, and Brookfield are also reporting. And on Thursday, Yahoo Finance's Invest 2025 event will feature Pfizer's Albert Bourla, Robinhood's Vlad Tenev, and former Fed Vice Chair Lil Brainerd, all voices shaping the next chapter of market confidence. But the real drama will unfold behind the scenes. Will Congress end the shutdown? Will NVIDIA's next earnings call on November 19th reassure investors or confirm fears of overheating? And can AI companies pivot from hype to real, repeatable revenue? Segment 9, what it all means. This week's turbulence is a stress test not just for portfolios, but for belief systems. For months, markets have operated on faith in exponential growth, but now they're being reminded of the one rule that never changes. Growth is expensive, and debt has consequences. We're also witnessing a deeper philosophical divide between innovation as a tool for progress and innovation as an investment vehicle. When companies start buying stakes in their own customers just to sustain demand, you have to ask whether capitalism is financing creation or simply recycling optimism. And when Washington grinds to a halt amid an AI arms race with China, the contrast couldn't be striker. Machine learning at light speed, policymaking at a crawl. So where does that leave investors and ordinary Americans? In limbo, but not hopelessly so. Corrections are how markets catch their breath. They force clarity. The AI story isn't over. It's just maturing. NVIDIA, Palantir, Meta, and Microsoft are still generational companies with transformative potential. But as we enter the final stretch of 2025, valuation discipline is back in style. Meanwhile, the ongoing shutdown is a reminder that data, governance, and confidence are as critical to capitalism as any algorithm. As the noise fades and the charts settle, one thing remains true. The age of artificial intelligence will reward the rational, not just the early. That's all for today's editorial edition. Markets may wobble, politicians may stall, but the world of innovation and the truth of value always finds a way forward. Thanks for listening. I'm your host, and this was your Pie and Cut Market Editorial for the week of November 9th, 2025.